Welcome to today's Explainer. Today, we're putting on our expert investment analyst hats to solve a massive financial mystery unfolding right now in Latin America's largest e-commerce market. We're looking at a company that is absolutely firing on all cylinders, yet somehow seeing its stock price punished. So we're unpacking the 2026 financials of MercadoLibre to understand exactly what the market might be missing.
Okay, let's dive straight into this jarring juxtaposition. MercadoLibre just posted its fastest revenue growth in 4 years. We're talking a staggering 49% year-over-year jump. Yet, instead of cheering, the market immediately punished its stock with a near 13% drop the very next day. In the financial world, we call this cognitive dissonance. When top-line growth is this explosive, you usually expect a massive rally, right? Not a sell-off?
And this brilliantly illustrates the longer-term pain. When tracking historical performance against major indices like the S&P 500, Dow, and NASDAQ, MercadoLibre, trading under the ticker MELI, is extending a 12-month drawdown of roughly 32%. This most recent post-earnings plunge has pushed the price back down to multi-year lows, which completely diverges from the broader market rally we've seen almost everywhere else. Section 1. The MercadoLibre Paradox. So what exactly is driving this massive disconnect between phenomenal top-line growth and a plummeting share price? Well, let's look at the actual numbers. The headline revenue for the first quarter hit an absolutely staggering $8.85 billion. Let that sink in for a second. That represents a $35 billion annualized run rate for a company that is now 26 years into its life. It's incredibly rare to see a mature, established platform accelerating at this pace. To look at this through the lens of legendary investor Peter Lynch, this is a massive stalwart behaving exactly like a fast grower. They aren't just defending their market share, they're aggressively expanding the total pie. But here is the core of our paradox. While that revenue surged 49%, the bottom line tells a completely different story. Operating income declined nearly 20% to $611 million, dragging operating margins down with it. Consequently, net income fell 16% to $417 million. The market looked at this profit contraction, panicked, and hit the sell button. But as analysts, to figure out if that was actually the right move, we have to see what they're spending all that money on. Section 2. E-commerce and Fintech engines. To understand where the money is going and why costs are rising, we need to break down the two massive engines powering this top-line acceleration. In commerce, management made a very deliberate structural change. They permanently cut the free shipping threshold in Brazil. Now, this wasn't a temporary promotion. It's a new standard. The result? A massive 32% surge in unique buyers, literally the fastest pace in 5 years, and items sold shot up 56%. But here is the brilliant part. They absorbed that insane volume while actually improving their logistics economics. Because route density increased so much, the actual cost per shipment dropped 17% in local currency. This is textbook Warren Buffett economic moat building, folks. They are absorbing massive volume while driving down their unit costs. Meanwhile, the fintech arm, Mercado Pago, matched that acceleration step for step. They grew net revenue by 51%, pulling in $4 billion for the quarter. And their active user base, it exploded to 83 million monthly users. Mercado Pago is no longer just a simple payment processor for the e-commerce site. It's a sprawling digital financial ecosystem that's rapidly becoming the primary financial relationship for millions of Latin Americans. And get a load of this credit data. They more than doubled their credit card book to $6.6 billion year over year, issuing 2.7 million new cards. But they're doing this while successfully managing risk. Their provision coverage remains highly stable, reserved at over 149% above the face value of 90-day past due receivables. They are even underwriting better than incumbent banks in Argentina's brutal 32% inflation environment. Why? Because they possess a unique data moat. They see exactly what these customers are buying and how they behave every single day. Section 3. The margin squeeze. So how does this incredible growth directly connect to that alarming drop in profits that so thoroughly spooked Wall Street? The absolute crucial point here is that this margin compression is entirely deliberate. It is not a failure of operations. As the CFO explicitly stated to investors, we are not optimizing for short-term margin. They're seeing incredible returns on their spending, like that Brazil shipping threshold cut, and they're pressing their advantage to capture what they view as a once-in-a-generation market share opportunity. Basically, they're choosing to win the decade, not the quarter.
Part of that deliberate investment is going heavily into technology. They've rolled out the Claude AI assistant to 31,000 employees, making them one of the largest enterprise adopters globally. But more importantly for the bottom line, they are shifting away from traditional keyword search and entirely rebuilding their marketplace architecture around large language models. And this isn't just a corporate buzzword. It's already lifting ad conversions and click-through rates for sponsored listings in key markets like Brazil and Mexico.
Section 4. Valuations and peer comparisons. With margins squeezed but top-line growth absolutely exploding, how does this actually affect the fundamental valuation of the stock today?
Well, if we pull the historical ratios directly from the financial data, we see massive multiple compression over the last few years. The price-to-earnings ratio currently sits around 49, compared to a dizzying 807 back in 2021. The price-to-sales ratio is down to roughly 3 from nearly 10. If you're a value analyst, this significant multiple compression implies a growing Benjamin Graham-style margin of safety, especially since the business is fundamentally larger, more dominant, and currently generating a highly impressive 27% return on equity. And when we benchmark MercadoLibre against its closest emerging market growth peers, it's holding its own perfectly. At 49% growth, it is sandwiched right in the top tier, sitting comfortably between C Limited at 47% and New Holdings at 53%. They are proving, beyond a shadow of a doubt, that a legacy e-commerce player can still compound revenue just as fast as the absolute newest digital darlings in the market. What you should really take away from this is the future trajectory. While peer companies are expected to begin decelerating in the coming quarters, consensus estimates show MELI maintaining its unique growth premium. Analysts project MercadoLibre will sustain a massive 42% top-line growth rate into the next quarter, effectively widening the gap between itself and its competitors.
Section 5. Wall Street Forecasts. Let's synthesize all this data to see how the professional analyst community is actually pricing this deliberate investment cycle.
So despite the recent stock drop and the retail market's panic over near-term profits, a literal wall of conviction remains among the pros. Out of 24 analysts covering the stock, 15 rated a buy, 5 rated outperform, 4 are holding, and there is absolutely zero, not a single sell rating on the board. The street sees exactly what management is doing. Because of that conviction, the street mean price target currently sits at $2,217. Compared to recent trading levels where the stock has been lingering in the $1,500 to $1,600 range, that implies a substantial 36% upside. The street clearly believes that once the market digests the structural growth, the valuation multiple will normalize upwards. Zooming out even further to look at long-term intrinsic value, institutional DCF, or discounted cash flow models, paint a fascinating picture. The ticker mid-case valuation model, assuming they can sustain a 24% compound annual growth rate, suggests the stock could theoretically exceed $8,500 by 2034. Given they just posted 49% growth, that 24% hurdle over the long run starts to look highly achievable if they execute on this massive market grab. Which leaves us with this final thought for today's explainer. As observers, value analysts, and investors, are we focusing entirely too much on this quarter's net income while completely missing the birth of an unstoppable Latin American e-commerce monopoly? The data strongly suggests MercadoLibre isn't failing to make a profit. Rather, they're deliberately spending it to build an economic moat so wide, no one else will ever be able to cross it. Thanks so much for joining me on this deep dive. Keep questioning those headlines, and I'll see you in the next explainer.